banks make money, and can you recreate that system but to your benefit instead of theirs? Hey y'all, I'm Erica Neal and I'm your host and wealth strategist and infinite banking practitioner. Today we're going to get into some real money talk on how banks make money and how you can recreate that process for yourself utilizing the infinite banking concept. So it's been called a lot of things: infinite banking, bank on yourself, be your own banker, right? We keep using this word bank over and over again. But the problem is we really need to understand how banks make money before you can recreate that process for yourself. So when we get into this is going to be just a brief overview of how banks make money and what does it look like when you decide to become the banker for yourself and implement infinite banking into your own cash flow system. Now, the big takeaway here, and I've said it once, I'll say it 100 times more, this is a yes and not an either or. And so this conversation today is going to really dive deeper into what does that look like and what does it mean that infinite banking is a yes and not an either or. And so as we look at that again, just keep it in the back of your mind. Whenever you're using infinite banking, you're putting cash inside of this policy, not to keep it there, not to get the best rate of return ever, but what we're going to show you is you can become the bank by recapturing interest, creating arbitrage, and improving your compound interest curve, all while you're continuing to invest in real estate or fund your business or do whatever it is that you're doing. So again, you're able to do both while recapturing interest and again, creating more benefit for yourself instead of allowing the banks to keep all the profits. So we're going to dive into that one today. If you want to learn more about what infinite banking is, again, we've got some other videos that touch on the summary of that. But again, we're using a specially designed cash value life policy. And so today we're looking at recreating the banking system to your benefit instead of the banks by utilizing this policy and putting it into your cash flow system. Let's get started. Okay, so like I mentioned, we're talking about becoming your own bank, bank on yourself, be your own bank, right? We keep using this word bank over and over again. So as we're getting into this, it's important to realize if we want to recreate the banking system for ourselves, we have to know how the banking system works. How do banks make money, right? If we want to be them, we need to, understand it, digest it, and then restructure it to our own benefit. So there are a few different sectors of the financial industry. We're not going to go into all of them today, but banks specifically, as one of the legs of the financial world, their number one source of income is through loans, okay? Now, if we are wanting to recreate the banking system and be the bank, that means you have to transition. This is the hardest part for people. You have to transition from thinking like a consumer to thinking like a banker. No, that's it. And again, that doesn't happen for everyone. But what that means is you're doing a 180-degree turn in the way that you look at and use and view money. Here's what I mean. Let's say you come to me and I'm your banker and you deposit money in my bank. Is your deposit, if I'm your banker, is your deposit my asset or my liability? It's a liability. So the deposit to a bank is a liability. Again, 180-degree turn from what consumers typically think. Now, what's going to happen, though, is as the banker, I turn that liability into an asset by loaning your money out to someone else. So Robert Kiyosaki gave us a very good, simple definition of an asset. Assets put money in your pocket. Bottom line. So on paper, when we're looking at a bank's balance sheet, loans are considered assets. Okay, so again, loans are assets, deposits are liabilities. And again, it's an asset because I'm charging, let's say 5.2% on that loan. And that is creating cash flow to me as the banker. Now, with that, I might pay you on your deposit, what, 0.2%? Oh, let me move that. I might pay 0.2%, right? Virtually nothing. Very, very, very little. But this is the liability that I have. I'm paying a little bit to go out and earn a lot more, okay? This is creating what we call arbitrage, okay? Paying a little bit to go out and earn a lot. Now, when we look at this, I'm going to use a deposit amount of $10,000. So when we numerically look at this, on a deposit of $10,000, that means that I paid you $20 so I could go out and earn $520. So I paid you $20 for the year for that $10,000 deposit. I lent your $10,000 deposit out and made $520. You with me? Now, on the surface, this looks like the bank's profitable transaction amount is $500, which is that true? Yes. But when we look at it, what's the rate of return? This is the profit amount, but what is the actual rate of return? If I'm charging 5.2 and paying 2, does that mean that I'm earning 5%? No. That only tells us the spread. What we have to understand, the money talk here, is the interest rate spread is different than the actual return on the transaction. Now, let's look at this like an investment, which is technically what it is, right? The bank has invested $20 in you to borrow that money, basically. They're borrowing that money to go lend it out to somebody else, okay? Now, if the total net profit is $500 at the end of the year after having invested $20, so imagine investing $20 and profiting $500 off that investment in 1 year. If you divide that out, that means that you would have multiplied your money 25. The bank multiplied that $20 25 times in 1 year. Said another way, that's a 2,500% rate of return. 2,500% rate of return. Now, I'm not even going to go down the rabbit hole of, again, I talk about banks all the time and how many times they've had to been bailed out, and I don't understand when you're making this kind of profits how that's possible, but again, I digress. That is a pedestal for another day. The point is, when we look at this, the actual rate of return, the actual return on the investment transaction is much higher than what we see on just the spread, okay? And if you ever want to look at this, there's a great report. It's called the Bank of America Bauer Report. We got these numbers from the Bank of America Bauer Report in 2016. So this is real, y'all. These are the real numbers that are being analyzed here. So when we talk about becoming your bank and why would you want to be the bank, well, let's pause for a minute and zoom out. Throughout this entire process, the entire process of deposits in, money out, and all this, who has gotten the most use, control, and who profited the most throughout the entire process? The bank did. So who else would you want to be in this scenario, right? When we actually take a look at what's happening throughout the entire time, the best person to be here is the bank. So how do we recreate this system? We can't, if we can't beat them, join them. We can't get mad at the banks for doing what they're doing, right? Like, why don't we, if we see what they're doing, why don't we just recreate it for ourselves? So instead, this process here, everything that's happening, we're going to recreate it, take the bank out of the equation here, and put you in the middle instead. How do we go about doing that? Well, that comes into what we call the savings dilemma. And this stems from, my background in the traditional financial planning world. That space is very much a my daddy can beat up your daddy, right? Like everybody's better than the other guy. Don't do this, don't do that, right? It's always, oh, they suck. Or if you put money with that person, you're going to lose. Here's the thing. At the end of the day, my philosophy and kind of growing in financial maturity, I've come to realize that there's no such thing as a good tool or a bad tool. There are, however, different tools for a job. So if I give you a hammer and say, hey, here's your hammer, is it a good tool or a bad tool, what would you say? It depends, right? Like, what are you trying to do? And that's exactly the point. We should be figuring out what are you trying to accomplish and then use the right tool designed for that job. Because if you try to cut a piece of wood in half with a hammer and be like, oh, this hammer sucks. No, it doesn't. You're using it wrong. And so often in the financial industry, that's what happens. That's why people are like, oh, annuities suck, or oh, insurance, or oh, like nothing sucks, right? You're using it wrong. So we need to identify what are you trying to accomplish and then use the right tool for that job so you can be as effective and efficient with your money as possible. When we're looking at this with the savings dilemma, and when we're talking about, coming back to the savings dilemma, what I found was so many people felt torn. Where should I put my money, right? Like, so again, everyone's always saying this is good, this is bad, whatever. They're confused and kind of just, where should I be putting my money? Plus, there's only so much money to be going around, okay? So where should I be putting my money? Where's the best place? And again, that comes back to what are you trying to accomplish and focus on that first. So when we're looking at this, there are three functions of your money, three things that your money is going to need to do, or three jobs it needs to fulfill. It needs to perform short-term, intermediate term, and long-term functions. Now, what are the different tools you need to fulfill each of these jobs? Well, short-term is pretty self-explanatory. That's going to be a bank account, right? We can't get rid of these guys. Like, they do serve their purpose. Why? But when we look at like why people are putting money into a bank, just a plain old regular bank account, most people are putting money in there because they feel safe, right? Like, it's better. I always put that in quotations, but it's better than your money being in the mattress, right? Now, there's also the element of liquidity, being able to quick, easy access, pay bills, go to the grocery store, do whatever, right? Pay for club volleyball. Ugh. But moving on. The catch to this, though, on the downside, there's really not any growth. That's not what this is designed for. This tool is not designed for that. So this is money that you need to use within the next 0 to 12 months. Otherwise, you're losing money due to inflation, especially in today's environment. Now, on the other end of the spectrum, let's look at your long-term category. This is going to include any and all investments, everything. This could be real estate. This could be your stock portfolio, your business, your 401k, whatever, okay? Something that over the next 7 or more years, right, depending on age and timing and all that, it's going to take 7 or more years for that asset, for that investment to come to fruition, okay? So what we're doing in the investment category, why are people putting money into this box? Well, most of the time they're hoping for some level of growth. Hopefully, right? Now, I say hope because we have to acknowledge that all investments carry risk. All investments carry risk, okay? Even real estate. Ask me how I know. That's another video. But all investments carry risk. So we have to know they're not safe. That's fine. That's the nature of an investment. But we just have to acknowledge that. We also know that investments are not typically liquid, meaning once I have invested into this given deal or asset or whatever it is, that is tied up for a given period of time, okay? We can't just, quick go swipe a card and get to it. So now this is where most people stop. Most people feel like, oh, well, I've got my short term taken care of and I've got my long term taken care of. Check and check. But here's the problem. And I think most entrepreneurs feel this too. There's a dynamic here that kind of poses an issue. If you want safety and liquidity, you have to sacrifice growth. And if you want growth, you have to sacrifice safety and liquidity. So you can either put your money into an account for the next year or lock it up for 7+. That is a huge gap. That is a huge gap that's been created here in the middle of most people's financial plan. So when we're looking at this, especially again, entrepreneurs are thinking, well, what about money that I might need today, but it needs to benefit me over the long term as well? How do I bridge the gap between my everyday bank account transactions and my long-term investments? I need to fill in all the holes here of what is not being addressed. Okay? You already have your bank, you already have your investments, short-term, long-term, but we need to fill in the gap here of what's not being addressed. Now, when we're looking at what do we need, we don't want to put in anything that's already been addressed. So for example, if you have a hammer, you don't need another hammer. If you have a saw, you don't need another saw. We need something that has completely different characteristics that are complementary to the other things in your portfolio, in your financial toolbox. So for example, if you have a hammer and a saw, we need a screwdriver, something totally different. Now, what are those aspects that we need to check off the list? Well, we're going to give you the ability to earn guaranteed growth, right? More than what you're getting in your bank. We're also going to give you true safety and protection. It is going to be liquid, quick, and easy to access. We'll throw in some tax benefits, right? We're going to give you privacy and protection of your assets. And we're going to give you control over money going in and out, okay? So when we look at all of these characteristics, guaranteed growth, safety, liquidity, tax benefits, privacy, and control, all of these characteristics, that's why we refer to IBC policies as the vault. Okay, so think of a safe in your garage or basement or closet or whatever, right? Tell us where you keep your safe at home. Why don't you write that in the comments? I'm just kidding, don't do that. But if you have a safe, think about that. You can put money in when you want. You can take money out when you want. It's safe, it's protected, all of that. But here's the question. Who knows how much cash you have sitting in your safe at home? Just you, right? Nobody else. It's completely private. So that's exactly the dynamic that we want to create inside of this vault. That's exactly what these IBC policies serve, and that is the purpose that they fulfill. Now, how do we recreate the banking system just like we saw earlier, but put it to where you are in charge instead of the bank? Well, before we get into that, be sure you like, share, subscribe, ring that bell so that you can always stay up to date on all of the different videos that we have and continue to help us create some reality behind money talk and get real with what's going on with your money so we can make better decisions. In the meantime, let's come back to the cash flow, right? Recreating a banking system and creating that same system within your cash flow of your business, of your real estate, or whatever. Now, how does this work? Well, you're going to take money out of your bank and you deposit it. Let me change colors here. We need different colors. So you're going to take money out of your bank and use it to fund your IBC policy or your vault. You're depositing money into the vault. Now, that, just like the bank, it is a liability. So how do you turn that liability into an asset? You generate a loan. You take a loan against your IBC policy and you use that loan to lend it out and go make more money in an investment. Now, the investment cash flow is what you use to pay that vault loan back. Okay, so you're using your investment cash flow to pay your vault loan back. Now, you are earning more in your investments than what you're paying into your policy, right? You're making money in that investment, so you're earning more than what you're paying into your policy, and all that leftover money that doesn't fit or that you've already paid everything off, that leftover money trickles down into your bank account. But now guess what? Now you're too liquid in the bank again. So you need to put more money into your policy so you can do more investments, and you rinse and repeat that process over and over and over again. So again, coming back to Robert Kiyosaki, he talks about the velocity of money. I like to call this the flow and grow, where we are consistently allowing your money to move and flow between all the different assets that you have. It's not put it in there and let it sit there like stagnant, stinky water. We don't want that. Water that moves and flows, that creates life. That creates, right, a whole new pathway. It creates everything. That's what you want your money to be doing. You want it flowing and growing, okay? Now, yes, if you can't tell, there is some subliminal messaging here. That is what we do. So Infinity Investment Strategies, that's what we do. It's not just about hey, here's an IBC policy and then we slap your butt, you're out the door. No. We're very focused on education. We get the policy set up and designed and, we structure it and tailor it specifically to you. But then even once the policy's in place, we're here to help get that deployed. All right. Hey, if you're doing a cash flow deal or you're looking at doing an investment, hey, let's map this out. Let's create a cash flow plan. Let's do a deal analysis, whatever it might be. We've had a lot of clients that do deals with each other or invest in our other clients' deals because we are introducing them and creating this network of people that are wanting to flow and grow. So again, this is just something to kind of emphasize, we're not transactional. This is something that we really want to help people understand and create these systems, not just understand it, get it implemented, but then once you have your policy, put it to work, get it going, right? Get your money flowing and growing, and we're here to do that for you. So again, with becoming your own banker, this is not, I'll be honest with you guys, this is not a set it and forget it. This is not a passive, I'm going to stick my head in the sand and hope and pray everything works out. If that is your way of doing things and dealing with finances, that's, all on you, great for you. This strategy isn't gonna play into that type of system. But for those that are wanting to take back control, put their money to work for them, make more money for them than for somebody else, that's exactly what this strategy is for. And so again, I wanted to point out, what does that cash flow system look like? What does it mean to recreate the banking system? How do banks make money? And then putting you in the middle of that arbitrage benefit instead of the banks. Now, of course, we're not going to have the same interest rate spread and all of the fractional reserve banking that, the traditional banks have. But to be honest with you, the financial system and the economy would be much better if the banks didn't have access to that either. So again, neither here nor there. The whole point of this is you can take back control of your money. You can put it to work for you. And it's really, really powerful to understand how money works, because when you understand how money works, right, how can you win a game if you don't even know how to play, if you don't know the rules? So the whole goal here is understand the rules of money, understand how it works, understand how these profitable businesses and industries like banking are raking in the profits so that you can recreate that system for yourself. So until next time, make sure you like it, share it, give us a comment, let us know if there's anything else that you want to see in these videos. We will see you next time, and until then, keep it real. At Infinity Investment Strategies, we teach investors and business owners how to become the bank. In using the infinite banking strategy, you can lower your taxes, increase the control you have over your own money, lower your risk against multiple wealth-eroding factors by adding additional layers of asset protection, and increase your leverage with guaranteed growth and the opportunity for dual rates of return. With authorized infinite banking practitioners with experience in business and investments, we are here to help enhance your portfolio.